Okay, welcome everyone to KJ Trading Systems back to Algo Trading School. And this is a 4-day event for algo trading. And today we're going to talk about some entries that work today. So it's going to be a great 4 days. It's going to be a little bit different information each day. So make sure you attend each one. So I want to welcome you and thank you. It looks like we had over 600, closer to 700 people sign up for this. And I know not everybody will be in the room because one, the room won't fit everybody, but I know a lot of people just get it just for the recording. So if you're listening on the recordings, welcome. And we'll start out like we always do with our disclaimer. This is not my disclaimer, it's the US government's disclaimer. Don't trade with money you can't afford to lose. Past performance is not indicative of any future results. Treat all results as hypothetical and realize whenever you see back tests anywhere, chances are if they look decent, they've been built with the benefit of hindsight. You know, somebody's selling you a trading system or something. They're not going to show you bad back tests, right? They're only going to show you the survivors, the good ones. And that's kind of what hindsight bias is. So if you remember those things and be very cautious with everything in trading, you're going to be in pretty good shape. Now, if you have questions during this event, just you can type them in now, but I probably won't get to them until the very end. That'll just make the whole presentation just kind of flow better. But I will definitely have time for your questions at the end because I know a lot of you have questions. All right. So, like I said, today is day 1 of 4 days. I hope you can make it for all 4 days because it's pretty boring when you're talking to like 1 or 2 people, and that's no fun. And right now we've got over 120 people in the room live, so that kind of gets me excited because it's kind of neat that there's so many people listening. So today it's 4 entries that work today. Tomorrow it's going to be a little switch. It's going to be money management and position sizing, and we'll talk about some of those things and things you got to watch out for with that because that's tends to be overlooked. And at the same time, some people overlook it, but other people put too much stock in it. And so there's a happy medium, and we'll talk about that tomorrow. Wednesday, it's not a sales pitch, but I am going to give you some really helpful tips if you're looking to buy a trading course or, do some kind of trading room or attend a workshop or something like that. It'll help you. It'll definitely make you a more savvy buyer. And that's not that long of a presentation. So we're going to have an extended Q&A on Wednesday. And then on Thursday, we're going to wrap it up. Since on Monday, we started at the beginning with entries. Thursday, we're going to finish it with exits. And I'm going to give you some exits that you should consider for your own trading. So this is cool because if you take everything I give you today, you should be in pretty good shape to build algo strategies. Or if you say, wow, man, there's a lot here. I want to find some outside help. You'll get that through that buyer's guide and just get some tips. So if you stick around for all 4 days, you're going to end up being a whole lot more savvy and a whole lot smarter with algo trading than you are right now. Can almost guarantee it. Today, 4 entries that work. Then we'll do our Q&A. And then at the very end, we'll do a book giveaway to some lucky people who answer a question correctly. So you do have to pay some attention. It's not a super difficult question, but I try to at least make the main point, and hopefully you guys will all get it. So it pays to listen. All right. So that's my promise for today, is to give you 4 entries. I'm going to show you exactly where they work. And part of that is I'm not giving any sales pitches. I might mention my course once in a while, but this is not if you sign up before the end of the webinar, I'll do this and, that kind of thing. This, just relax. It's just education. There is no sales pitch. There is no limited time offer that I'm going to be talking about today. Maybe at the end of the week, I'll do something like that, but not for these webinars. Okay. So looking at algo strategies, and entries are just a part of algo strategies. It helps to understand how most people develop them. And I've seen thousands of people develop algo strategies. And here's what most people do. They take their entries, which we're going to talk about today, and their rules and their inputs and everything, and they take all their historical data. So let's just say it's back to 2015. They put it together, throw it in their backtest engine, whether that's NinjaTrader, TradeStation, Multicharts, Python, whatever they're using. They've got some way to backtest this, right? Because that's a really important part about algo trading, is being able to backtest. But they run thousands, hundreds of thousands, maybe millions of iterations, and they find the best case. However they, want to find the best case. It might be net profit. It might be minimum drawdown. It might be winning percentage. A whole bunch of different ways to do it, but they get their best parameters. And then what most people do is say, well, hey, those were the best parameters for the last 8 years, so they should still work going forward, right? So they start trading with those. And if you take nothing else away from today, just remember this. Don't do that. That is the wrong way to do things. It's the absolute wrong way to do things. And people who do it end up having strategies that fall apart in real time. So if you avoid this, you're going to be so much better off. Don't optimize your way to trading. Now, that said, the process I use is right here, and you can feel free to copy it. I think the hard part's in the details, but if you look, what I just say, I said, well, don't optimize. But look at that step. It says walk forward testing and optimization. You say, well, wait, you just told us not to optimize. Now you're saying you do it. How do you reconcile that? Well, the way I do it is different than what I just showed you. It's a way to what I call intelligently optimize your strategy and to get your best parameters, but you're not necessarily trading the best case over that whole 8 period. So, and it's something I do called walk forward testing. We're not going to have time to go through it today, but that's what I use. And these are the steps I use. And I take a trading idea that's over near the top left, and I run it through all these other tests. And if it passes all these tests, then I'll consider it for live trading. But if it doesn't pass those tests, then I throw it away, move on to the next idea. And I'll tell you what, when you do it properly, there's a lot of throwing strategies away and moving on to the next idea. That's just the way it is. And some people get kind of upset about that, but this is the reality, is most trading strategies fail. Most algo ideas that you come up with, most that you read in books and see on the internet and wherever, most of the time they don't work. But the trick is to find when they do work and evaluate them properly. And so that's what this process is. Now, I'm sure you've all seen either YouTube videos or you've attended webinars or whatever, where they talk about these magic entries, where they say, well, this works, this entry, this indicator, whatever it is, this works on all markets, all bar sizes. I'm like, that's BS. Just remember that. Somebody says something works everywhere and every bar size. Oh, come on. That's insulting. But it's appealing, because you'd like to think, ooh, this guy figured out the secrets. He's unlocked the secrets to the market, and he's got this indicator that works everywhere and works on every bar size. Oh man, I got to get this. So you've probably all seen this, right? I'm sure you have, because I have. And every time I just kind of shake my head. But the interesting thing about this is they show them, and then how do they prove them? They usually show a couple trades. They show one chart where, oh, my fancy adaptive RSI picked the low and the high points, and look at that. This is magic. And you think, wow, this is pretty good, because you see one or two trades. But you don't see a 10-year back test. Nobody shows you that, because it doesn't exist, because they've never done it. And two, if they did it, it would show that their magic entries are failing. So this next 40 minutes or whatever, it's going to be a little different, because I'm going to show you, and I'm going to give you the specific markets and the specific bar sizes where the entries I'm going to go over, where they worked profitably and had robustness, meaning it's not just, oh, a value of 5 for a look back and everything else is bad. No, these are pretty robust over a 5-year period. So they're robust on specific markets, bar sizes, a wide range of input parameters. That's the robustness, and over a 5-year period. And I'm going to show you those results, because I went and back tested that. And of course, you don't see the ones that failed. I back tested a whole ton that didn't work, and that left me with these. So you can rest assured that these have been tested and they actually work where I say they work, because I've done the hard work. And most people who claim things work don't show you that proof. So that's a key point. Always make sure you see that proof, whether it's doing it yourself or whatever. As I mentioned, I tested a whole bunch of entries, and they were trend, counter trends, they were candlestick patterns, indicators, some of your classic ones. I tested a whole bunch of things. And the way I tested them for this particular study, I just did them as stop and reverse. So if blank, go long, which means if you are short, you reverse it and go long. And if something else, usually the opposite of the long rule, then you go short. But going short means you also exit your long. So you're in the market all the time, either long or short. And there are no stop losses, no profit targets, because sometimes those can fool you. What do you mean by that? Well, you can take just about any random entry, for example, and let's say you take that random entry, and which shouldn't be any good, right? And you put a little profit target of like 2 ticks. What's probably going to happen? You're probably going to get like a 90% winning percentage with those 2 ticks. And you might think, wow, this is a good entry. 90% of the time it leads to profit. Well, no, it only led to profit because of that exit. And so you got to keep in mind that the entry might not be that good. It might have been that the exit got you out so quick, and maybe it was a terrible entry. So you got to remember that. So I tested these just with the entries, with no outside exits other than the signals themselves. I tried it on 42 different futures markets, everything from cocoa to wheat to the euro currency to the Japanese yen to gold to copper to crude oil to the stock indices, everything pretty much, all the major US futures markets. And I did 6 different bar sizes. I could have done more. I just stopped at 6. And they went from probably like 60-minute up to daily. And then I ran a 5-year test with those. Altogether, I bet I ran probably around 500,000 back tests. So it was a lot of back testing. You might say, oh my gosh, if you've ever done back testing, you know it is time consuming, right? So how did I do that? I had a secret weapon. This software, it's called multi-op software, and it cuts development time, testing time, by about 93% in some tests I ran. I mean, it's just a huge time saver. And that's the good news. The bad news, if you're not a student of my course, you can't even buy it. So this was written by a student of mine, and we agreed that, hey, let's keep it within the course, and the only people who can get it are people who join my course. So the platinum course. And this is a great tool for speeding up your testing, and it helps you develop strategies a lot faster. So that's what I used here. Now, I should point out, I'm not saying these are fully developed strategies. You could use them as your starting point in what you're doing. And when you look at like what I did, I just did a modified version of what I call limited feasibility testing. So what I teach as part of my process is something a little bit different. So I modified it a little bit for this because I wanted to give you something that had a nice period of time, which 5 years, something works for 5 years. That's not bad. I like to test a lot longer, a lot of times, 10, 15 years, but this is a good start. And that's what I encourage you to do with these, is to now take these and then maybe go off and do your own testing. Here's entry number 1. Hammer, hanging man with long-term momentum. And I won't go through the definitions of hammer and hanging man other than just to show you. But what you're doing is looking for a downtrend, and then you get a certain candlestick, and then that signals that the price is going to start going up. And what I've added to it here is, let me highlight that, long-term momentum. So what you don't see here, it's going to be something like this, where maybe it's a long-term uptrend, and this might be, you know, a couple hundred bars, and then here's a shorter term downtrend, and then you get this particular candlestick, and then that's a buy signal, and vice versa for short. So that's all it is. So it's a hammer for the long side, hanging man for the short side. Here's the code for TradeStation. This is actually the whole strategy. And actually, I might have said it kind of backwards, but the momentum, yeah, the momentum is actually down. I'm sorry, I said it was up. I tested that one too, but this one came out better. So you can see right here, it's saying if the close is less than the close a certain number of bars ago, so that would mean a downward momentum, and you get this hammer, then you buy, and vice versa for selling short. So yeah, I'm sorry if I screwed you up before. I had it backwards, but this is the exact code in TradeStation. TradeStation has the hammer and hanging man as a built-in function, so you can do it fairly easily on your own. You don't have to program it, although you might want to if you have some kind of different parts to it. That's it. And you notice there's 2 inputs that I'm going to optimize here. There's the length over which the hammer hanging man is calculated, and there's this momentum length. So both of those I'll look at, and I'm going to do 10 values of that long-term length and 10 values that hanging man. So 100 iterations altogether, right? 10 times 10. And what I'm looking for here is a majority of those combinations show profit over a 5-year period. So if only one of the 100 showed a profit, that would not be good, right? I want to see 60, 70, 80 of the 100 show profit. And if it does, that shows that it's robust. What does robustness mean? It means you can vary the inputs and still get decent results, meaning profitable results. So that kind of shows some robustness. Now, I didn't go for any minimum profit except above zero for this. There's obviously some, you could make it a higher and say, oh, it's got to make $10,000 in 5 years or something like that. But I found, hey, as long as it's profitable, that at least shows there might be something there. And it's not saying 100% it's a great strategy, but it's saying, hey, this could be a good strategy. Why don't you take a look? And that's what I'm doing here. So here's an example trade. I didn't identify where the exact hammer was in Hanging Man, so I apologize for that. But I did this on a whole bunch of different markets, and here's where it worked. So I'll explain this table a little bit. What you have in the first column are the market, the instrument. Okay, so you have things like rough rice, feeder cattle, cocoa, live cattle, sugar, platinum, and so on. And then you have the bar sizes along the top: 60-minute, 120, 240, 360, 720, 1440, which is sort of like a daily bar. And if it worked, if enough iterations were profitable with 60-minute rough rice, then this gets assigned a value of 1, and so on for all this. And so remember I said I tested 42 markets, and there's not 42 there. There's only 26. So there's a bunch of markets where this didn't work at all on those 6. But here's where it did work. And what you'll see is the top 4 worked with all those bar sizes. Well, that's not bad. That shows some robustness there. And then if you look across the bottom, you'll see 720 and 1440 are the best. They have the most hits. Okay. But this gives you very precise of where it works. So for example, Canadian dollar right there. You could try it with the 60-minute, 240-minute, but I wouldn't try it with the 120-minute, or if you do, you're liable to see bad results. And it worked with 720 and 1440. And so you see, if I clear this, what's interesting here, it works best with the ags and the softs. So, if you look at just the top 5, you have somebody's drawing. Okay. Please stop drawing, whoever's drawing. Okay, so you have rough rice, feeder cattle. Those are ags. Cocoa, that's a soft. Live cattle, that's a ag. Sugar, that's a soft. And then platinum, Canadian dollar, and then coffee, that's another soft. So it works best with ags and softs. Doesn't work with some market sectors as well. But this gives you an idea where this particular one would work. That's entry number 1. Entry number 2, I probably should have guessed this one was going to work, because this is one of my favorite breakout entries. So many people say, oh, breakouts, most breakouts fail. Well, yeah, that might be, but when they work really well. Okay, somebody keeps writing, so hang on a second. I gotta okay. So anyways, sorry about that. Somebody was having some trouble drawing, so I don't know why. Okay, so the breakout entry, I find it works a lot of times. buy signal, you want long-term momentum to be up, and you want a shorter term signal close to equal your highest close. Oh, okay. Thanks, Dave. He said, gave me a tip on stopping people from drawing. All right. I'll have to remember that if somebody starts drawing again. I've never had that happen. So here's the code in TradeStation format. If the close is greater than the close a certain number of bars ago, so let's just say your momentum's up and you're at the highest close of a smaller length time period, then you buy, and opposite for sell short. So it's just a simple, it's not a stop breakout. Notice I'm buying at the next market, next bar market. And you can argue that might actually prevent some of those false breakouts, where the market moves during a bar and it breaks out, but then by the end of the bar, it's down. This would help with that a little bit, or it could anyways. Okay. So again, I tried 10 values of long-term trend length, the momentum length, 10 values of the breakout length, 100 combinations again. And again, I'm looking at as this is, hey, if most of those combinations are profitable, this could be good, just like the first time. So you see a lot of this is just the same. It's just a different entry. And here you go. You can't really tell. I don't know what momentum length this was, but you can definitely see that a short term, this was a highest close, and that's why it bought here. Here's where it works. Again, it was 26 different markets out of the 42 I tested. And again, 720 was the best, followed by actually 240 and 360. So some of those middle terms. So 720 would be a 12-hour period, right? And a lot of people don't use bars that big, but I find you have more success with the bigger bars. And you can see cotton's up at the top. Then you have some energies. You have unleaded gas and heating oil. We're going to see them in a few other entries. And then you have 30-year bonds, which is the US, and then the ES, soybean oil, and then we have the TU, one of the treasury note in the interest rate complex. So you can get an idea of where this works. So what could you do with this? Well, hey, if I was going to test a breakout, probably I would avoid trying it with Japanese yen, okay? Because it only worked one particular bar. And then, there's a whole 16 of them that you're not even going to see here. I wouldn't bother testing those with this. So right there, I've saved you a bunch of time this way. That's entry number 2. And we're just going to start hitting through the last couple. So it's going to go fast, okay? This is a momentum entry. I love breakouts. I love momentum. And this one's just saying long-term momentum up and the shorter-term momentum's up. So that makes sense. A trend tends to remain a trend, right? That's the idea with this. Now, you could also do it where the short-term momentum is down. So that would be sort of like a pullback. You're in an uptrend, and then your momentum turns down. You're in a little pullback, and that should get you going up again. Hey, that might work, and it does work pretty well. It didn't make the cut here for the top ones I found in my testing, but that would be another one to test. That's one I like too. But this one, what worked better was short-term and long-term momentum up. So let's look at the code. If you don't know TradeStation and you've never seen easy language, you should be able to figure this out, right? It's not that simple or not that complicated. That's why they call it easy language. If the close is greater than the close a certain number of bars ago, that would be, let's just say your price chart looks like this, and this is where your first bar is. This is your current bar. Okay, momentum's up. And let's say your close is greater than the close a certain other bar ago. That would be right here. So that momentum's up too. Well, hey, that's a trend, and it's just saying now's the time to buy, and vice versa if we're going short. So if you could understand that, and you're worried about, oh, I don't know easy language, I don't know how tough it's going to be. It's not that tough. You can use it, and if you understand this, yeah, you got to learn the syntax and all the keywords and stuff, but you know the basics, and that's always helpful. It's really helpful when you are able to read it, because I've seen some programming languages where it's really hard to understand what's going on. Not so with this. So again, you see a common theme here. I'm doing 100 possible combinations, long-term momentum length, short-term momentum length. Again, I sound like a broken record, but I'm looking for most of them to be profitable. And that could be that is usually a good sign. And this is what it looks like. The tricky part about this is, I just showed you like a straight line. And it's not always that case. So for example, I don't know what the lengths were of the momentum, but let's just say, you got the signal like right there. Let's say this length, whatever that is, that looks like to be about 25 bars. Maybe that's your long-term momentum. Your short-term obviously is like that. That's easy to see. Yeah, it's in a downtrend. But this one's not as easy. Is this really a downtrend? Well, half of it was up and then it was down. But overall, when you look at momentum, you're only looking at this point and this point, and it just, in your mind, I think you connect it with a straight line, but realize it doesn't have to be that way. This was definitely in an uptrend this whole time and then downtrend. But if the look back length was right here, that would still say, hey, according to momentum, you're in a downtrend. So just keep that in mind. It's not always perfectly clear where the trends are, and that it is a trend with momentum. It can kind of be a little tricky. So, yeah, I mean, you could obviously build upon that and make more momentums, or make it a longer length, or make sure that it never went this high up, because you say, well, that's an uptrend. There's a lot of different things you can do with that, but I just did the simple momentum. Where it works best, the ags, energies, interest rates, they're all at the top. Remember I said heating oil and unleaded gas were up there. They're up there again. Heating oil, especially. Crude oil's up there. And then we have the 30-year bonds. Cotton, remember we saw cotton in the last one. So sometimes a lot of these markets tend to work with a lot of different entries. And the higher time frame's better. And I wanted to bring that up. If you look at each one of the tables I give you, you'll notice where they work the worst is 60-minute bars and 120-minute bars. And you can say, well, oh, but man, that's what I like. I like doing intraday, and that's what I want to do. Well, yeah, you and me both. But the problem is those bar sizes usually don't give as good of signals as the bigger bar sizes. And you can say it's because there's more noise at the lower bar sizes, a lot more back and forth, where 40-minute bar, there was probably some kind of more trend movement. I don't know. And so I'm not going to try to explain it completely, but I'll say I've noticed that a lot, where the smaller the bar size, the harder it is to develop systems for. So just keep that in mind as you're building. Okay, our final entry is the reverse hammer and hanging man. So instead of buying when it comes down here, I'm looking for this hanging man to be a sell short signal. And this that's a hammer, I'm sorry. This hanging man, even though it's traditionally considered a sell or a sell short signal, I'm gonna buy with it. Okay. So it's the exact opposite. And this is kind of interesting because you wouldn't think that could be. But all I did with the code that I showed you earlier was just switch the buy and sell short. So I'm still looking for a down momentum, and then I'm looking for a hammer, and then I sell short. And a lot of people might be like, oh my goodness, how could you do that? Hammer's a long indicator, and you can only do long with it. Well, no, you do whatever you want, right? It's whatever works. And somebody somewhere figured out that the hammer and hanging man worked better a certain way, but it doesn't mean it can't work in the opposite way. And that's what I tried here. And again, 100 tests. And here's where it works. And again, the ags, energies, interest rates are where it works the best. Just kind of how it's showing up. It's weird. But it can work to your advantage with these markets. So this is where it works and what bar sizes. So it's kind of neat. Okay, so those are the 4 entries. And now you can use those to get started, and you kind of know what markets or sectors to look at and what kind of bar sizes. So it could save you a ton of time because you could probably come up with some decent algos out of these entries. But there's obviously a lot more required. You can obviously look at exits, add stops, and profit targets. I also do walk forward testing, Monte Carlo simulation, correlation testing. I do a bunch of other stuff as part of my process. So this isn't like the end, just say, oh, hey, tomorrow I'm going to start trading this. Well, no, you wouldn't want to do that. And let's say if you did, the first thing I'd want to do if I were you is to at least test it in your own platform and verify your results. Because sometimes different platforms will give different results. Maybe, for example, NinjaTrader has a different kind of definition for a hammer. And, the way TradeStation or that code I have defines it might be different. And there might be different TradeStation code that defines hammers different ways. So you want to test it for yourself first. You want to have confidence in it. And then there's a whole bunch of other testing that you want to do. And my general philosophy, my general thinking is, the entries are important, sure. But the process is what really matters. Okay. The entries are just a component, but what's really important is how you build this strategy, how you test it, how you evaluate it, so that you prevent overfitting, you prevent over optimization, curve fitting, all those bad things that you've heard about. The process is what's important. And again, this is the process I use. You can create your own process based on what I do. Some people have. And if you want to do that, you can certainly do it, because I did it, right? I created my own process, and that's what I tell other people now. But what you'd want to do if you're going to do this on your own, figure out if you have a good process to develop 50 to 100 strategies and be consistent in how you're doing it. And then watch those results in real time for a year or two to see if they really work. And if it doesn't, you adjust the process, and then you create some more strategies with your new process, and then you watch that real time. And eventually you're either going to give up or you're going to develop strategies that in the future turn out to be profitable. And this is exactly the steps I did way back when, probably 15, 20 years ago. Because I didn't know what would work. Is over optimization really bad? Can you have 10 inputs? What do strategies look like with it? And that's how I developed my process, was really through trial and error. And the errors were painful because a lot of times it was market losses. You don't want to do that, but you can definitely do this on your own. And the key is you have a process that's based on actual facts. The fact that some author tells you that a higher high followed by a lower low is a good buy with no proof, that's not based on fact. That's just based on some dude saying it. Now, if you can test it and you can say, yeah, oh yeah, 70% of the time this works and gives you a profit of at least this much before it goes bad, then it would be good. But watch out for that, because it's so easy to say stuff without having data to back it up. I try to back up everything I say with actual data, and it's either my testing or my market experience. So this is very difficult to do on your own from scratch. Okay, so to wrap it up, we did 4 entries. We did the hammer hanging man. We did a breakout. We did a dual momentum. There was a short-term and long-term momentum. And then we did the reverse hammer hanging man. And all of those work in multiple markets with multiple bar sizes. They don't work everywhere. Truly, they don't. Some markets, probably none of these work. But at least I've given you a lot of food for thought of where these work. And the way I proved this was by running a 5-year test, just to see if those strategies were robust through all those iterations. Okay. And then, at the very end, I talked about having a proven development approach. I think that's really important to what you're doing. Okay. So we'll get to Q&A in a little bit. If you happen to be a Strategy Factory student already, probably by the end of the week, I will get you the codes for all this, so you don't have to type them all in. It's just one of the benefits. But of course, you can just stop the screen and type it in. These are pretty simple, right? So I just wanted to mention that, and let's go to the Q&A. And not a sales pitch, but if you're interested in my workshop of learning the process I teach to build strategies, just go to this link or hit that QR code, and you'll be taken to the page and learn all about it. So type in some questions. We got about like 10 or 15 minutes for questions, so should have enough time to get all your questions. If I don't get to your question, feel free to email me afterwards. You can go to my website and get my contact info, or it's kdavey@kjtradingsystems.com. And I'll be glad to answer it. Okay, so I'll just start going through these. We have a bunch, and feel free to add more. It doesn't necessarily have to be on entries, but I would say, hey, if it's a money management question, just save it till tomorrow. If it's an exit question, maybe save it for day 4 when we talk about those things. Dave P is asking, do you backtest using back adjusted contracts or just the continuous ones? Good question. So the answer is I use the back adjusted continuous contracts. If you use back adjusted with, if you use unadjusted continuous contracts, you are going to get incorrect results, because the back adjusting accounts for gaps. And for those of you who don't trade futures, you won't even know what we're talking about, but it's basically every futures contract has a limited life, and then they have a contract month and date to them, or month and year. So like crude oil rolls, it goes every month. There's a July crude and an August crude and a September, and the continuous contract stitches those all together. So I use a back adjusted continuous contract that works for 95% of the cases. There are some limited situations where that's not a good idea to use it. And I discuss that in my course. It's a little too in depth to get into for today. But don't use the unadjusted if you're just going to run a standard strategy, because you're going to get really goofy results. Sean mentioned there's a lot of ag markets. Yeah. Yeah, there were quite a few ags that showed up in a couple of those entries. That was kind of interesting. Faisal says, do you trade, or Faisal, hopefully I pronounced your name right. Do you trade ICE US futures? The data feed is very expensive. Yeah, you know that it's like 120 something a month. I don't know. I'm considered a professional trader, so I pay a lot for CME data too. But with the ICE exchange, you can trade dollar index, which I like trading, coffee, cocoa, cotton, sugar, orange juice. Those are the major ones. And so what I'd recommend if you're looking at those markets, if it's just one strategy, if you have one cocoa strategy, $100 a month is a lot, 150 or whatever it is, to pay for data. I would probably wait until you got a couple strategies and then do it. But yeah, that's the tough part about it. Dave, oh yeah, he said about the annotation. Dave, by the way, who just helped me out with that, is the creator of Multi-Op. So he's not only a creator, he's also a listener. So Dave's a great guy, and he took the course probably 7 years ago, I bet 7 or 8 years ago, and he's developed this great software based on it. It's truly incredible what he has done. You would think it was like a team of people. No, it's just Dave. David A, can you say something about the condition of getting out of the strategies? So all those strategies, all the entries that I gave you today, they were stop and reverse. So when they got a long signal, they got out of the short trade and then went long, and then vice versa for the short trades. So they were always in the market, long or short, but that was the only way they exited. So I wanted to just see what those entries did to it. And like I said, if you'd put stops and targets and other things on it, you're going to definitely get different results. Okay, Patrick is asking, what does pass mean? And did I include slippage and commission? So pass is basically a profit. You want to have profit after slippage and commission. You have to do all your testing with slippage and commission. I see people who ignore it, and I think they fool themselves, because it's a real cost and you have to include it. So a pass for what I was doing here just had to be profitable, and that's kind of based on that limited testing I do. Okay, Brent is asking, were all these entry tests performed using the bar closing price? Yes. So, and you could see that in the code where it always said if close greater than. So it was always the closing price of those particular size bars. Mark is saying, this is awesome. I need to drop. I sure hope the recording will be available. Yes, you will be getting an email probably tonight of day 1 of the recording. Yuriv, if you put all entries and exits that work in the same strategy, will it create a super strategy with better profit? Not necessarily, because a lot of times the interaction, just because A is good and B is good and C is good, just putting them together might interact differently, and they might not all be good. So you can definitely take those entries I gave you, and if you put exits with them, you can actually, even though the exits might be good by themselves, they might not be good. So that's why you got to test the whole thing. Paolo is saying, do you save your entries in TradeStation format, or do you just save the ones that pass preliminary testing? I save pretty much everything, and then every once in a while, the ones that don't work, I kind of call them out. But I used to delete them right away when they didn't work, and then I'd find myself going back and, oh, I already tested that, and you'd want to look, and then it's gone. Okay, Ori, why do you only test on futures? From your experience, will running algos on stocks work? No, you can. And actually in my course, I do talk about some of the issues with stock trading. I'll just give you one: algo trading with stocks. You're going to build an algo. What's one of the first things most people do? They pick an instrument. I'm going to do Amazon. Well, I can pretty much guarantee almost whatever strategy you create for Amazon, as long as it goes along a lot, you're going to do well with it. And why did you pick Amazon? Well, because in the back of your mind, you knew it did well. And that's what you got to watch out for, is some of your biases can do that, can influence what you're picking. Where if I told you build a strategy for gold, probably 9 out of 10 people wouldn't know what the 10-year history of gold looks like. Is it up, down, up and down? So you can definitely use this approach with stocks. I use it for futures for that reason. For if you're in the US, the tax treatment with futures is so much better than stocks. And I like the diversification better with futures, because you have all these different sectors. Now you could mimic a lot of that with ETFs. I get it. But I think it's better with futures. And then of course you have the leverage part of it, which you don't really have with stocks. Okay. Saeed saying, what's a good period for optimization for your in sample and out of sample? You want to, it really depends. And the way I teach with walk forward, you can look at a variety of them. You want to pick them before you actually do it. But I would say if you optimize an in sample a couple of years and have your out of sample 6 months to a year, that's pretty reasonable. Adam's asking, what objective function did I use in optimization? Do I like Bob Pardo's PROM as an objective function? I usually use net profit, and I know, like Bob Pardo's book, I read it a few years after I'd been doing this for a while, and I think after I won the trading contest, and he said only a complete idiot does net profit as objective functions, as what's best. But I found a lot of use into it, and it turns out when net profit's good, usually your drawdowns are low. Ideally, what you want is some kind of risk-adjusted measurement. But when you look at walk forward software, up until the time when this multi-op tool came around and fixed it, most walk forward tools did it incorrectly. And I won't go into details, but it did. There's some technical math issues, and so it was easier just to use net profit. But I've also done some studies with it. I do use some other things. But for most people, net profit's going to be just about as good as anything. A lot of people think there's this holy grail of fitness function, that there's going to be some master function that unlocks the universe to profits. Not true. At least in my experience. Okay, David K is saying, I think different platforms have different methods to calculate bars. Maybe a 120-minute bar ninja is different than 120 on TradeStation, or even how they define close. It could be. So with I know with TradeStation, you can base your bars on actual time or on time from the beginning of a session. So there are some ways to get different bars. So that's a good point. David P saying, oh, he's talking about continuous contracts. Yeah, I normally don't use those custom ones. I just use the base continuous contract, which is what I did for this, just at CT for cotton and that kind of thing. Okay, a couple more questions, and then I do want to end it. So I hopefully I'll get to them all. So I'm going to start answering them quicker. What type of entry signals to avoid issues with continuous back adjusted futures contracts? Basically ones that use percentage price. Okay, another question. Want to ask about boundary between preliminary and walk forward. Are trading ideas getting through some tests? Are they simple optimization or just from our brain or internet? You can get the trading ideas from anywhere. And this is something I do discuss in great deal in my class, but any idea is good. It's just got to pass all the tests. And there's another question about futures and versus stocks and ETFs. I think I answered that. How do you optimize if you haven't got access to multi-opt? TradeStation has the optimization built in. Most platforms do. That's what I'd use, and that's what I used for years and years before multi-opt came around. You can still do it. It's just a little more laborious. And there's another question about ETFs versus futures. And Sean says ICE also has Brent and gas oil, but ICE Europe is another $100. Yeah, ICE gets you with a lot of fees. Here's a question. Do you make adjustments to sessions for your back testing contracts where there's higher volume or active trading? You certainly can. You can just, I've done that where you have just custom sessions where, hey, I'm only going to look at trading crude oil from 10 to 2. That's something else you can do. Jake wants to know about recordings. Yeah, they're going to be sent out tonight and every night after. George is saying, what are your experience for preferred ways to determine slippage? So I again, this is a little more in depth, but I share this in my course, just the results of all my trading and a bunch of statistical analysis of what proper slippages are. And I provide those to people. But yeah, it's kind of a little tricky if you've never traded to know what the slippage would be. Any plans to adopt multi-op for Ninja? No, I don't think there is. I think Dave's worn down just from using TradeStation. And the only reason it was even possible was because TradeStation allowed backdoor access to some of their calculation engines, which I don't think Ninja even does. Okay, Thomas is saying he created an expert advisor with like MT4, MT5. And then he said he has the same robot with a bunch of different variables in the same instrument, which shows profitable results. Well, hey, that's the key if you can do it. But a lot of times I find strategies will only work on one market and nowhere else. And would you ever enter at the market if the signal turns on before the bar ends? Probably not, because you can't really backtest that. When you start to, let's just say you did a moving average crossover and during the bar, the crossover occurs and you say, well, it just occurred. I got to enter right now. You could do it with like a stop order. You could also do it with a limit order, but you got to be careful of how you do that, because you could get in a situation where, depending how you set up your strategy, where what you backtest is not what you get in real time. So you got to be very careful with that. There's something in TradeStation, it's called intrabar order generation, and I avoid it because I've seen a lot of times where it just doesn't work with back testing. And your back test results will show one thing, your live trading shows another. Defeats the purpose of back testing. Okay, by the way, if you have more questions, just save them for tomorrow, because we're going to end in about 5 minutes. Jake's asking, when he holds overnight, do you keep any hedges in case of black swan? No, I don't, but I do have a diversified portfolio, so a lot of times that has some built-in kind of hedging. But honestly, if a black swan happens, the only hedge that's going to really protect you is being flat. You can minimize your risk with some hedges, like maybe you're long ES and then you sell some options to offset it. But realize too that when you take off some of that risk, you're going to limit your upside. So there's always a balance there. Okay, Rick is, do you find strategies that are better all the time in the market or limiting time? I personally like limiting the time, but a lot of times the ones that work better are the always in, long or short. And the part of the reason is because they tend to jump on longer trends earlier, where you don't have to wait as long. But I have a mix of both in what I do. Sometimes I'm always in. Some of them only trade a couple days a week. So it really depends. Faisal's asking about courses that I provide. I would just hit your camera on that QR code. I don't really want to make this a sales pitch, so you can find out all the information on what I offer there. And or he's saying, do I have any consistent strategies working with 1, 2, 5, 15-minute bars as opposed to 60? I think out of like all the strategies I have probably 200 strategies that I look to trade on any given month. And I would bet you less than 10, maybe even less than 5 are 1, 2, 5, or 15-minute or in that time frame. So it's a lot harder to come up with good strategies for that. When trading live, do I run strategies on continuous contracts? Yeah, I run them on the tradable continuous contract in TradeStation. If a strategy only works in a few markets, will you reject it, or will you only trade it in these markets? No, I usually will trade it wherever it passes on my tests. So part of my criteria is not that something has to pass in multiple markets. Now, some people do say, oh, it's got to pass in 5 different markets. And if you feel that's important and you have data to back it up, go for it. Because you got to do what you feel confident in and what you have data to back up. And last question, what's a reasonable expectation between backtest and real-time trading? I'm assuming you mean as far as how they should match. So what you could do, the way you could test this is run a strategy live for a week. Then at the end of the week, go back and look at what the backtest results are for that week. And the results, when you include slippage and commission, should be pretty close. And if they're not, if you get, let's say, live a whole bunch of entries that don't show up in your backtest, then you know something's way off. And that's what you got to watch out for. Okay. So in the meantime, if you want to learn more and just see some more free videos, go to my YouTube channel, Algo Trading with Kevin Davey. And remember, tomorrow is going to be money management, position sizing. I think you're going to find it interesting, and it might be a little different than some stuff you've heard out there. So make sure to stop back in. And of course, it will be recorded. Each session's an hour and or a little over in this case. So come by again tomorrow. Now, what I'm going to do, I'm going to give this package of 3 books away to the correct answers, the 3rd person, 5th person, and 7th person who identify this question, answer this correctly. So get ready to answer. I'm going to go 3, 2, 1, and I'm going to reveal the question. You put the answer if you're the 3rd, 5th, or 7th person, and you get it right. then you'll get it. All right. So let's go. 3, 2, 1, 0. What is the most important item below? A, to get good entries, what we talked about today. 2, to use a proven strategy building process. 3, to heavily optimize. Or D, to historically test a strategy. Okay, I think you guys can stop. I think we have enough answers. So we're going to go with the third correct answer. So Wendwen had the first correct answer. Jeff had the third of, I'm sorry, he had the first one. Jeff had the third one. So Jeff M, you won. Jonathan G, you won. And Jonathan and I just talked last week. So now he gets some books. And the 7th one is Ryan H. Okay, so that was the 3rd, 5th, or 7th. And the correct answer, of course, is B, use a proven strategy to building process. That is the key. And part of that process does include historically testing a strategy, which is D, but just doing a historical test by itself doesn't really help you if you do it incorrectly. So anyways, thank you. And remember, tomorrow, there will be another chance to win those books. And I want to thank you for watching. Again, I will be sending out a link to the meeting probably later on this afternoon or early evening. All right. Well, thanks, everybody. I hope you had a good time. If there was something you particularly hated about it, feel free to send me an email. And if there was something you really liked, that too. And Jeff, Jonathan, and Ryan, if you can send me an email, that'll be the quickest way to get you the books. All right. Thanks, everybody.